Hello everyone. In this recording, we are going to discuss investing in bonds. So let's start. This is chapter 12. So, what is a bond? So, whenever you invest in a bond, you are giving your money to the company issuing the bond. So, that's the first thing. You give your money to the company issuing the bond. That is, you buy the bond. So when you give your money, it's like company is taking a loan from you. So you give your money, company takes that, company uses it for its own business, and at regular intervals, company pays you cash flows. So these cash flows are similar to interest, but they are called as coupons. So when you give your money to company uses that money and starts paying you cash flows. And when the bond matures, company gives back the principal. So how it works, you invest some money, you buy a bond, company takes that money, uses it for its own business, and when the bond matures, company pays you back. Okay? The when you buy a bond, you pay price of the bond. Okay? The payments that you get from the company, in regular payments that you get from the company, the cash flows are called as coupons. And when the bond matures, company pays you back the face value. So this is how a typical bond works. So let's go. So bond is a corporation's written pledge to repay a specified amount of money along with interest. The face value is the dollar amount that the bondholder will receive at the bond's maturity date. So face value is what you get when the bond matures. Maturity date is the date on which the corporation is going to repay you. The legal conditions are described in the bond's indenture. So indenture is a legal document that describes what are the different conditions of bond. So which company is issuing it, why is it issuing, what is the total debt the company has, all these things are mentioned in the bond indenture. So bond indenture is a legal document that details all the conditions relating to a bond issue. Now, when you give your money to a company appoints a trustee. So trustee oversees the company's operation on behalf of bondholders. So company is a bondholder's representative that oversees operations of the company. For example, if company is not able to pay you back the coupons or something, then the trustee can sue the company and recover it from company's assets. So company trustee is a bondholder's representative. Now, between the time of issue and maturity, corporation pays interest to bondholders, and usually in North America it is semi-annual, and the rate is mentioned in the bond indenture. So rate is generally fixed. There are some bonds that where the rate changes, but in a vanilla setting, the rate is generally fixed. So dollar amount of annual interest or the cash flows that you get is face value into interest rate. Now, why do corporations sell corporate bonds? So, corporations need money. So, to borrow money to pay for major purchases like machineries, majorly oil and gas companies, when they have to open a new oil rig, they need money for that. So, to finance that money, they generally issue bonds. It is difficult or impossible to sell stocks. The financing ongoing activity is required to get money to operate or expand. The interest paid to bondholders is a tax deductible business expense. So this is a major difference. Dividend is paid out of profits, and for a company it is not tax deductible. In a fact, company has to pay tax when it pays dividend. But when company pays coupons, those coupons are tax deductible. So you get tax deduction on whatever interest you are paying to bondholders. So that's the major difference between dividends and coupons. Types of bonds. So there are basically, the first type of bond is a debenture bond. Debenture bond means there is no specific asset that is kept as collateral. So you as a bondholder have a general claim. So whenever you see debenture, it means you don't have a specific claim, but you have a general claim. What does it mean? That company is not identifying a particular asset as collateral. It is saying that if I don't pay you, you sue me and recover it from all my assets, not a particular one. So most corporate bonds are actually debenture bonds. They are backed only by the reputation of issuing company, not by a specific asset. Mortgage bond, a corporate bond that is secured by various assets of issuing firm. So there is a specific asset that is kept as collateral. For example, if you're building a bridge, I'm an infrastructure company and I'm constructing a bridge from Vancouver to Vancouver Island. So what I can do is I can keep that bridge as collateral and raise money from bondholders. If I'm unable to pay coupons, the bondholders can take over the bridge and collect money from tolls that currently I am receiving. Subordinate debenture bond. So it is an unsecured bond that gives bondholder a claim secondary to that of other designated bondholders with respect to interest payments and asset. Subordinate means they are paid last. So first normal bondholders are paid interest, then if anything is left, then subordinate bondholders are paid. So they, in terms of priority of paying interest, they are paid last, means they are paid second to the normal bondholders, not last. The dividend means shareholders generally are paid last. Second thing is, when the company closes down and it has to pay back the bondholders by selling assets, then also subordinate bondholders receive payments later than normal bondholders. Convertible bonds, these bonds can be exchanged for normal stock. So if you're having a bond, you're having a normal bond, you can exchange it with the company and get normal stock. So they can be exchanged at the owner's option for a specified number of shares of common stock. Most of the bonds have a call feature in them. Call feature is, company, if it has money, it can repay the bondholders. Now when it is useful to have a call feature. Example, I am Royal Bank of Canada. I issued bonds when the interest rate was 15% and I have issued a 30-year bond. Now few years later I see that interest rate has gone down to 10%. So I issued bonds at 15. Now everyone is issuing bonds at 10%. If I have a call feature, I'll pay my bondholders their money back. So I'll buy all those bonds again back from the bondholders and I'll issue new debt which is cheaper. So most of the companies issue bonds with call feature because it helps them to reduce the cost of borrowing when the interest rate goes down. So call feature, corporations can call in or buy back outstanding bonds from current bondholders before the maturity date. Most agree not to call bonds for first 5 to 10 years. After that, they become callable. They call the bonds if interest rate they are paying you is very much higher than the ongoing rate. Most corporate bonds and municipal bonds are callable. Now, there are certain provisions when bonds are issued. A sinking fund can be one of the provisions. Sinking fund means company agrees that from every year's profit it will put aside some funds, and these funds would be used to buy back bonds by either calling them or by buying it from open market. So sinking fund is used to decrease debt. So a fund to which annual or semi-annual deposits are made from profits of the company for the purpose of redeeming an bond issue. Serial bonds, so these are series of bonds that mature at a different date. Mostly municipal bonds are issued in that way. So every 5 years, certain proportion of the bond matures. So let's say it's a 20-year offering. Every 5 years, a certain proportion of bond matures. or if it is a 5-year offering, every year some part of bond matures. Then there are other types of bond, for example domestic, foreign and euro bonds. So domestic bonds is a Canadian company issuing bonds in Canada in Canadian dollars, so that's a domestic bond. But if Canadian company goes to United States and issues bonds in American dollars, that becomes a foreign bond. And when a Canadian company goes to United States and issue bonds in euros, those becomes euro bond. So these are generally issued in country and currency of issuer, domestic, and foreign bonds and euro bonds are issued in some other currency. Whenever as an investor you buy these foreign bonds, you are exposed to two kinds of risk. One is the investment risk that the bond has, plus you are also exposed to exchange rate risk. Okay, for example, I'm Canadian, I'm buying a bond that is American, so that pays in American dollars. Now I'm exposed to the investment risk that the bond has, the performance of the company, the bond of which I'm buying. Also, I'm concerned about what is the exchange rate. Example, if Canadian dollar becomes stronger, when I convert those American dollars to Canadian dollars, I'll get less money. So if you are taking exposure to foreign bonds, your domestic currency getting stronger is actually bad for you. So you're hoping for domestic currency to weaken. So important thing is, whenever you take exposure as an investor to foreign bond, you're adding risk, you're taking on additional risk of foreign exchange. Units: two or more corporate securities bundled by an investment dealer and sold at an overall price. So generally they combine bonds and they sell them. Strip bonds are also called as zero coupon bonds. So coupons of bonds are sold separately. So zero coupon means they don't pay any coupon rate. You buy a bond at a particular price. Let's say it's 1,000 face value bond. You buy it at 900 and you redeem it at 1,000. In between, there are no coupon payments. Now this is generally a misconception that stocks always beat bonds. So even if stocks do not always beat bonds, the financial industry will always tell you otherwise, because most brokerage firms profit from investment banking commissions on stocks. So stock commissions are much higher than bond commissions. However, there have been long periods when bonds or even T-bills have outperformed stocks. Using Canadian long-term bond total index and S&P TSX composite index, that is the stock index and bond index, a big period from 1970 to 2016 shows that the bond index was performing better or as well as stock index. So why do you purchase bonds? So there are two kinds of returns that you have. First is the regular coupon payment that the bond pays you. So let's say an 8% coupon, so 8% divided by 2 if it is semi-annual, you get every year. Plus you can also get appreciation. So if you buy bond for let's say $900 and the face value is 1,000, so bond is actually going to appreciate. So as a bond holder, there are two types of gains. One is the coupons that I get along with the appreciation I get. For interest income, investors know the interest rates, that's beneficial. Interest will always be paid to investors, generally twice a year. Appreciation can also happen. You may be able to sell bonds to someone else at a higher price, or the maturity price can be higher if interest rates on the bond is higher than the market price. Bond face value will be repaid at maturity. So you can either sell the bond to someone else or you can redeem the bond. You can get capital appreciation in these two ways. Along with that, you keep on getting coupon payments. Interest income method used to pay bondholders their interest depend on how the bond is registered. So generally when bonds were started, they were in bearer bonds. Bearer bond means they give you a bond certificate. There is no name on the certificate and the coupons are attached to that certificate. So every 6 months you tier one coupon, you go to the bank and get paid. That was the bearer bond. The risk was if your bond gets stolen, the person who has it will get the payments. So they moved to a registered bond format. So again, it was a paper-based bond in which your name was written. You tear off the coupons, you go to the bank along with your identity card that you are the person who is same as the bondholder, and you get paid. Now we have moved to an electronic format. So all bonds, the payments generally happen through electronic deposits. So a registered bond is registered in the name by the company or government who issued it. A registered coupon bond is registered for principal only and not for coupon. A bearer bond is not registered, so anyone who holds it gets the money. A zero coupon bond is sold well below the face value, pays no interest, but it is redeemed at face value. Now, bond prices are sensitive to interest rates. If interest rates are going down and you are getting paid more than the market, then value of your bond goes up. For example, when interest rates were 15%, I bought a bond that was paying me 15%. Now bond payments do not change, but interest rates change. So interest rate went down to 10%. Now my bond is more valuable because I am getting 15% while rest of the market is getting 10%. So when I sell it, I'll sell it at a higher price than what I bought it at. So bond prices go up when the interest rate go up. And let's assume that I purchased a bond when interest rates were 15%, but the interest rate right now in the market have gone to 20%. So everyone else is getting paid 20. My bond is paying me 15. So value of my bond goes down. So when interest rate falls, the bond prices go up. When interest rate goes up, the bond prices go down. So price of a corporate bond may fluctuate until maturity. Usually it is caused by changes in interest rates. If interest rate falls, the price of the bond will increase since its coupon rate is higher. If price of the bond rises, if interest rates fall, the price of the bond will rise since its coupon rate is higher, it will sell at premium. If the interest rate rise, the price of the bond will fall because it will sell at discount. So bond price, how do you calculate? So this is a crude method. So find out the dollar amount, find out the coupon that the bond is paying. For example, in this it is paying 4.875% coupon. So in a thing of 1000, it should be 1000, not 100. It is paying you $48 in coupon. Now you divide it by the current interest rate. So 48.75, that is the coupon payment, divided by current interest rate gives you the price of the bond. This is approximation. How do you do it? Actually, you put it in this calculator. You put in the face value. So face value is always future value of the bond because that is paid at maturity. You put in the interest rate. So interest rate is 4.8. Then you put in years to maturity, that is period, that is 10. Interest payments per year, so how many interest you get per year, and the current market rate. So the best way to know it is, we'll take an example. So no, I don't need these files. I know. Example, it's a bond that is paying you 7% coupon. The face value is 1000. It's an annual bond for simplicity. The face value is 1000. The interest rate in the market right now is 8%. And it is a 5-year bond. So years to maturity is 5. Now how do you calculate the price of this bond? So price of this bond is always present value. So you need to calculate present value. Rate is interest rate in the market, 8%. Period of the bond is 5 years. Signs are important now. Payment is how much yearly do you get from this bond. So coupon rate multiplied by face value. So coupon payments per year is always coupon rate multiplied by face value. Future value is face value. Type of the bond is 0 always. So 960 is the price of the bond. So this is how you calculate it. You put it in your calculator and do it. Bond repayment at maturity. You may keep the bond until maturity and then redeem it, or you may sell the bond anytime to another investor. The value of bond is closely tied to corporation's ability to pay. For example, means GM is closing a few of its plants. So the moment this kind of news, negative news hits, the bond prices of GM will fall because probability of General Motors paying its bondholder decreases. So any positive news, any positive profits, the bond prices generally go up, and negative news that threatens the coupon payments, bond prices generally go down. Other investors will pay more for a quality bond. Now comparing bonds to GIC, so guaranteed investment certificates that are issued by banks. So bonds included in a portfolio to generate steady income, stabilize returns and provide security. GIC is similar except banks issue it, but it provides more protection as the value is guaranteed by the bank and it is insured by CDIC. Bond have higher risk, so bonds higher risk of default, therefore the interest rates are also better than GIC. So if you invest in bonds, you generally have a higher risk than GICs. They are not guaranteed, but the interest rates are also better. And also GICs cannot be sold in market, but bonds can be sold in the market to take advantage of market fluctuations. A typical bond transaction. So bonds are sold through a full service or a discount brokerage firm, or you can buy them or internet. Bond market is generally, bonds are not traded majorly on exchanges. They are traded over the counter. Bonds or investment dealers are generally paid fees when you buy. Types of bonds. So Government of Canada securities, for example, means GSECs, that's they are called as. So these are issued by Government of Canada. Marketable bonds, so they have specific maturity date, interest and are transferable. So if I buy it, I can sell it to someone else. Treasury bills, these are short-term bonds that do not pay any coupon, but they are discounted from their face value. So it's like you buy it for $950 and it pays you $1,000 when it matures. But these are short-term instrument. Canada savings bond, so this started when we were having wars and we had to finance our wars, but it was continued in 1960s. But the popularity of Canada savings bond has decreased a lot and it has been discontinued now. So these pay regular or compound interest. Real return bonds, so these are extremely popular now. So they have, so their coupon rate and principal, that is the face value, adjust according to inflation. So as the inflation goes up, the coupon goes up as well as the maturity value goes up. Canada Premium Bonds has higher rate of return than Canada Savings Bond, hence Canada Savings Bonds was discontinued. Federal government sells bonds and securities to finance national debt and ongoing activities. So we means if we have a budget deficit, so we need to finance that deficit from somewhere. So we do it by issuing bonds. Government bonds are generally considered low risk investment, but it depends on which government are you investing in. So if you are investing in Venezuela, so that would be extremely risky now. These offer low interest rates than corporate bonds. Provincial governments issue bonds to fund program spendings and fund deficits. So these are called as municipal or installment debentures. So key things: government bonds are generally safer, they pay lower interest than corporate bonds. You can get a federal debt, or you can get a federal bond, or a provincial or a municipal bond. Can corporations, government, or municipality? So whenever you make a decision to buy certain bonds, you need to check whether the company or the government you are investing in has the ability to pay you back. So can the corporation, government, or municipality pay back the face value at maturity? Will you receive interest payment until maturity? That is why government bonds are generally considered safe, because government has taxation power. So if it is not able to pay bondholders their money, it can increase taxes and get money from the citizens. So that is the reason they are generally considered to be safer. You need to read the annual reports of the company you are investing in. Check the company's website for more information. Look for signs of financial strength and weakness. Is the firm profitable? So if firm is not profitable, they may not return back your money. Are the sales revenue increasing? Are the long-term liabilities, that is debt, increasing? How is the bond rated? So there are rating organizations like Standards and Poor's and DBRS that rate bonds. So AAA is the highest rating and D is the lowest. Generally, when you are investing, triple B is a benchmark. So all bonds that are below triple B are called as speculative bonds or junk bonds. So they have high risk of default. All bonds that are above triple B are generally called as investment grade. They have little lower chance of default than the speculative grade. And as the rating increases, the chance of default decreases. Junk bond, it is a type of bond that offers a very high return, but it is very risky as bond is nearing or currently in default. So these are rating bodies like Standards and Poor's, Moody Investors, Canadian Bond Rating Service, then DBRS, that is Dominion Bond Rating Service. So this is how they rate their bonds. This is again saying what we discussed. So triple B and above all are investment grades, triple B and below are speculative grades. Higher the bond rating, lower is the probability of default. So bond yield calculation. So current yield, it is dollar amount of annual interest divided by current market value. So how much you're paying and how much you're getting back, that is what you put in this formula to get a percentage. It helps you to compare. So coupon rate is, let's say I'm getting $80 and I'm buying the bond at 900. So my current yield will be 80 divided by 900, which will be approximately 11% plus. Then this is something that we don't have to, because we'll do it through our calculator. So as you have calculated price of bond, you can also calculate yield of bond. So if I'm buying a bond for $900, it is paying me 8% coupon and it is maturing at $1,000. How much gain am I making, considering that I'm getting coupons as well as my bond that I'm paying 900 for will mature at 1,000. So you put everything in calculator and you do it. So for example, I am buying an annual bond that has a 8% coupon and a face value of 1,000. Interest rates I don't know. The bond maturity is 5 years and I am buying this bond for $980. So I'm paying $980 for getting this bond. First of all, how much coupon will it pay? So if it is an annual coupon bond, it will pay me $80. So by putting in $980, I'm getting $80 for the next 5 years, plus when the bond matches, I'll get $1,000. So how much gain am I making? How much interest rate am I making? So we can calculate it by putting it in formulas. So NPER is 5, PMT is 80. I am paying $980 to buy it. When the bond matures, it will pay me 1,000 and type of bond is 0. Important thing, whatever you pay is negative, so 980 will be negative. You're getting $80 back, so that is positive. So PMT is positive and future value is positive, because when the bond matches it will pay you back $1,000. So I'm making somewhere around 8.51% return. Okay, so that is it in this recording. We'll catch up in the next recording for mutual funds.